Here we're going to move into the ECB and what's happening within Europe. So we're going to try to simplify it and just talking Germany and France for a moment, this segment, as well as just the Eurozone aggregate, because we want to look at what is going to happen with the ECB and what are some of the things that they face. So when we look at the Eurozone aggregate, you can see the CPI still is at over 8.8%, at 8.9%, moving up. We think that continues to grind higher. Eurozone manufacturing PMI was expected to be at 49, came in at 49.7. Service PMI was expected at 50.5, came in at 50.2. So the composite came in at 49.2, which is, again, still contraction, still showing some of that negative as the consumer confidence continues to be in negative territory, slightly above estimates. But again, there's still that pain that remains, and why we think there's going to be some of that pressure as we go over through the rest of the year. And the reason why we say that is because then we just look at Germany. So PPI month over month was expected to be at 0.7, came in at 5.3%. Year over year, it came in at 37.2%. So you're getting a huge surge in pain at the producer level, and that's going to, again, bleed down. So German manufacturing was expected at 48, came in at 49.8, but some of those intricate pieces that make it up, like delays have increased because of the Rhine, because of cost. You've had some things that are a net negative for an economic level, but are a net positive contributor. Service PMI, on the other hand, was expected at 49, came in at 48.2. So German composite was expected at 47.3, came in at 47.6. So again, you're seeing that pain going through as it's only going to mount as we progress, as the euro, the euro being at parity is actually helpful when you think about not so much imports, but on exports, because it makes it more attractive, because instead of being at $1.14, you're now at $1. So it's part of that benefit, but it doesn't benefit everyone equally as well. And we'll talk about some of those reasons in the next slide. Private consumption was up in 2Q, which we think falls in Q3. Capital investment was expected at negative 0.2, came in at negative 1.3%, while government spending was up big. So the government spending was expected to be at 0.6, came in at 2.3%, which was a big driver on some of that GDP quarter over quarter, which was expected at flat, came in at 0.1. And the government was a big one that helped kind of push that over the edge. Business climate was expected at 86.8, came in line with last month at 88.5. Current assessment was expected at 96, came in at 97.5. And then expectations were expected at 79, came in at 80.3. So it was essentially just the same month over month. And that makes sense when you look at people trying to process how bad is this going to get? Electricity prices keep going parabolic, and I think they're still in a panic mode, or they're kind of frozen and trying to figure out what to do as things progress going forward. Now, one of the things is the anti-fragmentation tool, which is where the ECB does its own type of operation twist, but between countries. So the ECB is at a turning point here. So ECB QE has also been about everyone, but now the ECB is buying, and under QE, they were buying bonds for everywhere. They were buying everyone's bonds, but that's not the case right now. So Germany and the Netherlands are getting quantitative tightening, while Italy and Spain continue to get quantitative easing. And again, you're seeing this pivot where they're trying to maintain and close the gap between Italy and Spain against Germany, Netherlands, France. And that's that anti-fragmentation tool. So you're getting where, all right, well, I'll buy Italian debt and I'll sell German debt in order to balance this. And again, that's where it's a very convoluted, essentially just operation twist. And this is what the anti-fragmentation tool looks like, and why we think it's so backward when you're kind of looking at this in context. So the Eurozone current account balance went negative, and a lot of that is obviously driven based on energy. So when you look at it, Eurozone trade deficit, non-energy balance is still positive, came down, but energy balance increased exponentially. bringing that trade balance down. The Eurozone current account fell into deficit in Q2. This is the first deficit in over a decade and is a warning that business as usual no longer exists, or no longer cuts it, if you will. So pretending that more debt is the answer and that needed structural reforms are austerity, it just, again, we just see that the ECB is painted into a corner, and why we do think, and you're starting to see in the market where the market is pricing in a 2% ECB rate, and then before they were at 0.5. So, I mean, you've seen a huge surge in that and change in what the assumption is that the ECB is going to do. The Eurozone is obviously in trouble. It had one growth engine, which is Germany, and that growth engine is now, again, really the one that's getting hit in the most trouble that, as we see it. And what's left are massive trade deficits, less growth, and less room to help those with huge debt overhangs, which is why, just as Operation Twist failed in the U.S., it's going to fail here because Italy, Greece, Spain have so much debt that the ability to, like, essentially the market is going to sit there and push the, a knee on throat type thing to the ECB and make them yield. They're trying to defend the euro against the dollar. They're trying to defend, high debt countries against low debt countries. And it's, again, this is where we think this really comes to an end. We think the dollar going to 115, and that'll push the euro to about 0.85, 0.84. And it's not something that that happens right now. We think it really is going to take into the back of September, October to see some of that give up. Unfortunately, it's going to be all at once. So in terms of trying to plan for it, if you want puts, that's great. So you just have the exposure, because it's going to be very difficult to just, snap your fingers and be there for it. So the S&P Global German manufacturing PMI new orders at 41.5, steeply negative, again, leading indicator. New export orders at 41. Again, all of this is just moving in an extremely wrong direction, which is why we see more pain ahead. And then when you look at the flash Eurozone PMI, dropped to 49.2 in August versus July of 49.9, signaling a reduction in business activity as the cost of living crisis sapped demand for services. More positively, there were additional signs of inflation softening. But now as electricity prices go to the moon again, nat gas prices go higher, we see that reversing once again. So input prices here, you can see that they've come down. Output prices the same. As we were saying, it's going to be lumpy. We do see this going back up because of a lot of these overhangs that we've already discussed. Now, when you look at German PMI new orders minus inventories, and Italy PMI orders minus inventories, the global recession is coming. But when you look at the forward-looking stuff in Europe, on Germany and Italy, it's already as bad as it was in 2008. And this data doesn't yet reflect the current spike in energy prices. And that's what we continue to talk about, where when these problems are getting there, the problems that are coming through, and where we see a lot of these underlying, again, it's a shock. And so when you get these shocks, it's going to take time for that to filter down, which is why we've been saying that there's just more pain on the horizon. And that's going to, again, keep those things moving in the wrong direction, which is why when you start looking at the overall piece, the Eurozone activity shrinks for the second month on the price squeeze, but and it's the second month of decline, signaling, again, that recession. But again, it doesn't even carry what has happened so far and what is going to happen as we head into the winter months. German PPI is just absolutely shocking. And this is something that's only in July. This, again, August was another huge month, to give you, put it into context. And even though I put these on here today, as of the 22nd, I mean, the German power and French power have already blown through this and have now reached new highs. So again, you're just seeing that compounding fear, especially as we said earlier, the more nukes have come offline in France, increasing that problem. which is why the S&P Global Composite, even though it's in contraction, we see a much steeper drop in coming up as the 50% of German, 50% of firms lacking staff. So you still have a staffing problem, which is going to keep wages kind of here, not really going back up. Unfilled jobs in Germany result. But then at the same time, the PMI is still negative. So it's like this weird conundrum of, well, you still can't hire people, so wages have to still stay elevated, but yet you're going to have to cut runs because your costs are going up. So we've already seen run cuts in FERTs and petchem, in construction and other things. So again, it's just weird back and forth, which is why we think that the firm side, a lot of those jobs are just going to go away or be quote unquote, hiring freezes. And so that's where we see some of the downside there. Private consumption, as we saw it in Q2, went up. German government support, though, remained elevated. And then when you start looking at services, you can see, again, slipping down. But then when we take German manufacturing export orders versus German IFO expectations minus current assessment, you get an idea that export orders are still going down. So there, again, all of the leading indicators for the really the economic juggernaut within Europe is all heading in the wrong direction. So even if you get some ancillary benefits, it's not going to be enough to offset this, which is why we have been and remain so concerned about Germany and how the August data is going to be just abysmal in comparison to even July, which was insanely bad on the PPI side, and why we see this, again, accelerating to the downside. So that's what we have for you on Europe. On the next segment, we're going to go deeper into China and Asia and some of the issues that remain within that continent.